Let me just give you our view of the world, a macro view. And this is a view formed across all the different Fiera businesses and the real estate practices in North America and in the UK. What we think we're going to see this year is more tenant defaults as rent collection continues to be an issue in June and probably in September. We think vacancy rates will rise across the board. And that's partly because if you don't have to pay your rent because the government have suspended many remedies, why would you? So we think that's going to become more and more of an issue. We then think the banks will be forced to actually act on that non-payment of interest. It's different from last time around, because last time around, it was just a valuation breach, which is a notional thing. This time around, you're not actually being paid the interest on your loan. So we think the banks will have to act, but will probably do so slowly because of political pressure to be more friendly. We think there's also going to be some demand shock. Consumers, we think, will be wary to rush back into that pub and club or that shopping center that they've been in before. Yes, they will want to get back out, and yes, retail sales will pick up once we're released, but I sense that there will be some changes there. And you have to ask yourself, how many of those mid-sized hotels or other leisure operators have enough cash to survive anything that's longer in terms of lockdown? So we think that that will lead in the short term to asset prices falling. This is mainly commercial real estate, but it will probably impact residential. At the same time, though, I am now talking to investors, not quite on a daily basis, but every week, about the opportunity to come back into the UK. We're starting to see investor demand saying, we've seen this happen before. We were here 10 years ago. We know what happens next. How do we do this? If we look then into next year, we're actually quite positive. We're quite positive because yields are falling across the board. The US federal government's balance sheet has grown by 50% in the course of 4 months. And there is nearly $5 trillion worth of additional liquidity being put into the market globally. That's pushing yields down on government bonds. That risk-free or so-called risk-free return is pushing yields down across all asset classes that provide income, and real estate is a great beneficiary of that reduction in yield. So you're going to see people prepared to accept a 2, 3, 4% yield, whereas before they wanted a 5, 6% yield, or whatever the number. We are going to see demand coming back as well. The UK's population grew last year by about 320,000 people. Now, it's tragic that we've lost 40,000 people from coronavirus so far, and that number could still grow. But the UK population is growing. It's the fastest growing population in Europe. It's the fastest growing of the major economies' population. So that growth drives demand. We will also see an economic recovery. It might take a year, 2 years, 18 months, who knows? But we will see a recovery, and that will lift especially assets like office warehousing. We'll see Brexit. I suspect there'll be a few twists and turns this year on Brexit, but that is likely to create more demand for people who want to sell, leave their assets behind and move elsewhere. Honda being an example, someone's going to have to regenerate that Honda factory into maybe residential, or you're seeing people coming. So we've just finished building Megit, a new engineering industrial facility in Coventry, which brings together half a dozen of their facilities they had previously. And I think technology is going to drive us to need new real estate. The stuff that we already have is designed for yesterday's employee, yesterday's culture, yesterday's working environment. We're going to need to build new stuff. That new office space is going to be better quality, better located, better amenitized. We're going to need more online retailing, logistics space. We're going to need more housing. So technology and the change in the way we operate is going to drive us. So short term, I would be cautious. I'd be careful about leverage, be careful about jumping into things that are taking high risks in the short term. I would watch liquidity because cash will be king. Medium term, good news, fellas, we're all, and ladies, we're all in exactly the right space. Real assets and real estate is going to perform great. So I'm very, very positive in the short term.